guys. Welcome. So one second. Okay, now we're live.
Okay.
All right.
Sorry, folks. Sorry for the delay. We were having a little bit of technical issues. This is something new to us. Welcome to the Market Huddle Plus, the Q&A with myself, and Patrick Ceresna, and Daniel, our intrepid engineer. How do you want to do this, guys? You want to talk about the markets a little bit, Patrick, before we start?
I absolutely. Okay. Absolutely. I mean, the markets finished Friday on the uptick, right? And right up along multi-week highs to go into Labor Day. And it just looked like the market was giving some of it back in the pre-market. And then suddenly the 10 o'clock ISM numbers came out and kind of created a steamroll. Obviously, we were debating as to how important that number is. From my interpretation, it was, or at least from what I've heard, was that it really showed some sort of inventory builds, which are usually a sign that precede layoffs, which continue to show labor weakness, kind of playing into that. That's obviously the market hasn't broken below Thursday's low. So I wouldn't necessarily call this, that the next kind of major market decline yet. On balance, I think the market is more likely than not to still remain more range bound till the actual jobs numbers come out on Friday, right? Like, I don't see why we would have a major trend move. Now you're shaking your head. Why don't you tell me why? What am I saying that is pissing you off?
Nothing's pissing me off. I think though you're missing a couple of things. First of all, we had the yen, big strength there. A lot of people getting nervous again that the yen carry trade coming unwound is going to lead to some weakness. So we saw that there's a big move in the yen, big move in Japan in the Nikkei that's kind of led this move lower. But more important than that, Patrick, it's September. It's a terrible month for stocks. Stocks are up a long way.
And so that's why on the last day of August, you take it to the high end of the 2-week range because September is so weak. Like, come on.
Well, no, you take it up there because you're marking your book. And listen, I've said this for a while. You should not read too much into the end of month ticks. Like, I've seen people make this mistake time and time again. You'll get a big move on the month end and especially the quarter end, and they'll start interpreting and they'll say, the market's telling me this, the market's telling me that. Well, the reality is, until you've sat on a sell side desk and watched clients jerk around stocks that are in their portfolios, the market's not telling you anything except who's the most aggressive at marking their books to where they want to book.
Well, but you're at the same time, I'm going to bust your ball. You're making the yen a big deal. You know where Friday morning the yen opened? At 146. It's trading at 145.80. Like, no, you're like,
I get it. I hear what you're saying. I'm saying though that the yen, the Nikkei led the move lower.
Yeah.
Like, that was where it came out of. That was leading all day, and then it started to accelerate here. Maybe you're right. Maybe it's the ISM. I just think it has more to do with September. I'm watching this. Do we actually, Daniel, how's this going to work? Are you going to interject with some questions?
Whenever you guys are ready, I can interject.
So for those who are interested, like, put in your questions. We're happy to answer them. Patrick will tell you all about, what his favorite beer is, what he does for time, like, what's the best bar in Lisbon. Daniel will tell you about his.
Well, actually, funnily enough, there's one comment here from Joseph saying, "Where is the beer?" So
yeah,
no problem,
so he fell down. It's noon. It's 1 o'clock here. I generally don't drink as much as Patrick. But Patrick, you're in Lisbon. It's like 6 o'clock or something. Okay, there he goes.
I'm going.
Okay, he's going to get the beer. In the meantime, do you have any questions for me that I can answer while we're doing this? Please shoot them in there, folks. We're going to have a lot of fun here. We're going to answer anybody's questions, anything that people have. Hopefully Patrick comes back. I do think, though, that he's been wrong in terms of what is causing the markets to sell off here. I really do think that it has more to do with the seasonality and that we're into some problems. And one of the things that I just, he's poo-pooing the idea that it's the yen related. I think that all these things add up and that we're having a lot of issues like that. The other thing is that China continues to shit the bed. We had some terrible numbers out of China in terms of the continued strength of the economy. It's just no sign of a bounce. Iron ore is gone, no bid. We saw copper interestingly enough, speaking about copper, that was one of those things that Patrick loves to talk about copper and say that it's Dr. Copper and it's got a PhD in economics. And the reality is
it's
that
original to me, by the way. It's original because it's never been said by anyone else.
It's just such a stupid thing. And we finally see Goldman Sachs, that was hugely bullish on copper, has come around, and now that it's declined, has said, okay, guess what? Copper's not going up. Almost feels to me like, that you should be fading that, and maybe copper's buy today. So Patrick's got.
Oh my God. No, I got a glass of wine. So
Okay.
just leave it at that.
Right. Should we get some questions?
Yeah, let's go. Go, Daniel. Let's do it.
No, I want to call your shit on this.
Okay, here we
go.
go.
Dip on copper.
Okay.
No, don't do it. Don't do it. Like
it's like you're like Michael Jordan.
No,
stop it. Get some help.
Okay. Switch to the chart. Let me show this chart here.
Okay.
Like this is a chart that has been in a primary downtrend. It was oversold when it got down to $4, and it spent a month retracing. The retracement barely reached its 50-day moving average, and it's 50% retracement. It is a classic flagging wedging formation, rolling right down. This stock is Eiffel towering all the way back to 2023 support lines. It's probably going to spend. Look, are we much closer to a bottom than a top? Absolutely. The thing is it made its high at $5+ It's not going much lower than let's say 375. But if you buy copper here, you're going to be in pain for the next month or two, watching this grind out a bottom. It's not getting bullish till later in the fourth quarter. That's my call. All right.
He's pretty bearish, folks.
No, I'm just saying you're early. You're always early.
Okay. All right. Go ahead, Daniel, with some questions.
Okay, so we'll start with William. What are your thoughts on XBI Biotech here? It's been unloved ever since 2021. Bubble pop, lower rates should benefit them, and supposedly big pharma needs M&A to fill up their pipelines.
So I'll talk about this. You know my theory about the series of mini rolling bubbles. I'm always looking for the next one. And I think that pharma has a very good chance of being the next rolling mini bubble. There's few stock sectors that can take the sort of flows that we're going to see when they finally go about selling Mag 7, which I do think, by the way, Patrick, has finally started. And that money has to go somewhere. It's not just going to sit in cash. It's going to go into something. And one of the few sectors that can actually handle that is pharma. And so I'm a huge buyer. I think the chart looks great, and it looks terrific.
I'm not going to disagree with your pharma call, but I think that you're talking, the potential for large pharmas to work. I mean, you see Abbott Labs working, you see Bristol Myers finally turning, Pfizer's off of its lows, Abbott Labs is ripping. Like there's you got your big, and even like Lilly is still doing great. The point here is that when you go to the biotech specifically, I think you have to focus on large biotechs, which is the IBB. Like I think the Amgen and the Gilead are likely to do better. But the problem with the XBI is it's particularly overweight, a larger distribution of more mid-cap names. And totally for M&A activity makes complete sense when talking about where would the takeover targets come. But the problem is most of these have 4-letter symbols, which is that they're overweight the NASDAQ, which is actually taking a particular abuse. And the thing is that I think that you'll my call is that I think that you're going to see the large pharmas outperform, and something like the XBI may disappoint in terms of not participating as well as large pharma.
Okay, well, there you go. So IBB over XBI, according to Patrick, but we both like it, so it's probably a sell. All right, Daniel, next question.
We got quite a few coming in, so we're
we're
gonna have to rock and roll. So let's see here. Oh, Nick Galanik is here. He's joining us.
Oh,
hey, Nick.
Am I?
Oh, Nick.
Nick. Okay, so what does Nick want to know?
No, he's just saying hello. So I'm saying hello backwards. So we have one from, I'm not sure how to pronounce that. I'm not going to try and
just read the question.
Right, okay. My question is, what are your views on EU economy, rates, stocks, everything? So we want a bit of EU love in here.
Well, you're not going to get that from Patrick.
I know.
They have great pasta in Italy.
So I'll start. I think that the US stock market is one of the most overowned, expensive markets in the world. And you say, well, what does that have to do with the EU? And I think it has everything to do with the EU, because if that bubble comes off, if we see a situation where we start to realize how overowned, how expensive the US market is, and that overweight that is prevalent throughout the whole world, if that overweight comes off, then what I think you're going to see is that other countries like EU, like the Japan, and things of like even Brazil, they're going to be a recipient of those outflows from the US into those things. So when I look on it on a relative basis, I really do think that the EU is not as bad as everyone thinks it is. And then you'll hear, whenever you start to get bullish on the EU, people say, oh, but the, regulation's so terrible. Oh, but the environment's so bad. And I say, yeah, okay. But everybody knows that. And people are already extremely underweight this thing. All we would need is a return to benchmark weightings for those things to outperform. So I actually happen to think that EU is a much better longer term hold than the US. And it has more to do with the fact that the US is priced for perfection. Everyone owns it. And that what you're going to see is as that comes unwound, EU will get a bid.
Over the long term, Kev, you might be right. You were right about the bond market. Eventually, 3-4 years later, this might one day come true that the euro will, the European markets will be massively outperforming. One thing I'll just identify on a short term basis, the whole trade, the whole. I'm choking here. The whole market has got a very strong correlation, and the rate cycle and the has all played out the same everywhere in Europe, in Canada, in the US. They've all have the same cycle going on, and I think that on the short term, as in the remainder of this year, the EU, like the Euro stock, will very much correlate with the S&P. And if we have a weak September-October period, the Euro stock will head right back down to those August lows where it was trading at 4,500 or even lower. You could have that long-term view, but I think on the short term, there's no reason to be looking as I would be a buy on dip trader when things come as a big buying opportunity and we're wanting to be long equities. Having Europe in your mix makes sense. But right now, I think that it's not a time to be, unless you're doing a long short pairing. You could do something like, long Europe against a short NASDAQ or something. But that's not usually how most people put on those trades.
Well, yeah. And what about the currency, Patrick? Come on. Say it. You love the US dollar. You love it.
No, I believe that the US dollar during a risk off cycle can recover a bit, but I actually do believe that when we go through a major commodity super cycle higher, will be a predominant US dollar bear market cycle. And it could be a 2025 story. On the short term, though, I think the US dollar during a risk off period in the next 3-4 months could recover right back to highs or even make a higher high on the short term. But long term, I'm not super bullish.
Okay. Next question.
I'm not that quick.
Oh, Daniel.
Right. So we've got one from Mr. Death Swap.
Okay.
So is the Fed rate cut going to be the biggest sell the news event? ? Oh,
that's a great question. That is terrific. All right. So it depends on what you're talking about the market. If you're talking about the stock market, I'm not even sure that the Fed cutting rates will get the stock market up. Like I think that too many people are focusing much too much on the Federal Reserve when it comes to the stock market. I think that it's like the old days we had a situation where equity guys didn't even know when the Federal Reserve was meeting. Like it didn't matter. And then what happened was in the post-COVID world, when the Fed was so aggressive, it seemed like that's all that people focused on. And now I think we're back to a point where the Fed doesn't really matter as much. They're going to go slow. The reality is when they cut, they're probably going to be just cutting along with the market, meaning that the market will have already priced it in. And so from my perspective, I don't even know if you're going to get a rally into the first rate cut. Like you've already had the rally into the first rate cut. So
I think it is. I think it's going to be a sell on news. So because we both agree it's going higher.
No, but so here's a question for you, Patrick. So we're gonna cut. Is it gonna rally into it?
I think that if the jobs numbers comes in a way that disappoints the markets and the market sells, it'll be very hard for the market to make it back up toward the highs by the time the rate cut happens. So I think the market might already be moving after jobs numbers, but I still think it's going to be a sell-on news event on the FOMC.
Yeah, I think it's difficult because I don't even know if I said to you, what number would you like to make the stock market go up the most on the unemployment number? Like, what would you say? Like, it's tough. It's difficult. You're not even sure what you want. And the reality is, I don't think that that's affecting the stock market as much as everyone thinks. Now, let's talk a little bit about the bond market, because I do think there could be a situation where that actually that first rate cut causes a steepening of the yield curve, and much to the chagrin of all the bond bulls like Patrick, you will see the long end sell off as the Fed is cutting. There you go. I said it. I know you love the bonds, Patrick. I know it. This is what happens when you have 40 years of interest rates just going down. Patrick can't imagine the interest rates ever going up.
No, I am not actually protesting your long-term secular inflation story and that the bond bear market will continue in years to come. I'm just tactically bullish bonds, and I don't think that I think the long end is going to still be a safe haven place.
Yep. So that's what makes a market, but I'm going to take the other side. So debt swap, I don't know about the stock market, but I do think that the long end of the bond market will be a sale on the first Fed cut. Daniel, do we have another question?
Oh, there's loads.
Okay, let's go.
We've got to speed this up.
Okay.
Okay, so we've got one from Chris H. Are you still bullish gold? More or less than before? Cheers.
I would keep going first, Patrick. You go first.
I remain bullish gold. I think a dip down to 2450 where it tests its previous highs and reaches its moving averages and stuff can be a tactical spot for it to drop on the short term. I think that's entirely possible.
Sorry.
Yeah, no, but I think it's a buy on dip.
So I think you shouldn't get cute about it, because the reality is that everyone thinks it's a buy on dip and that they're all waiting for the dip to buy. And I really feel like the best markets don't let you in. And every time that folks get all bared up about gold, it ends up being that all of a sudden out of nowhere, it gets a bit and it heads higher. So I'm trying not to overthink it in secular bull markets. Like, what did Dennis Garman used to say? There's like 3 different positions you can have: flat, which obviously you don't want, long, or really long. And to me, it's just one of these things that I feel like you should own as much gold as you can that would allow you to sit through the moves that inevitably will happen. But I suspect those dips will be shallower than most people think. All right. Next question, Daniel.
Okay. Right. So we've got one from Todd. He says, can you just address the question of crayons versus not? Both of you are quite successful, but approaches are divergent. How would you synthesize the commonality of your approaches versus your differences?
So, I mean, I don't think we actually differ that much, in a sense that, I mean, to me, fundamentals are the what's going to happen and why it's going to happen. It's understanding what is happening in the world, whether at a macro level or a corporate level. And the technicals are telling you how people are voting with their money. It's a map of flows. And the thing is, you can have a fundamental story that everyone can argue is great, but if you see the bid being hit persistently, and the stock is persistently making lower lows, and someone is distributing it, you can't see that in a fundamental number. You can observe that on a chart and watching the way the price action moves. So to me, I think they're a very important complement to each other, which is you want to always look for technically bullish things that have a great fundamental story, and you want to identify where are the tactical asymmetric levels to buy and sell.
So I give Patrick a little bit of flack about his crayon chewing and stuff, and it is fun. But at the end of the day, I follow charts a little more than I would like to admit. Having said that, I will say that probably one of the differences that Patrick and I is often time frame. Like my trades are often longer. And then the other thing that I will do a little more is sentiment. And I'm not looking for sentiment to confirm. And in fact, when people start agreeing with me, I feel uncomfortable. And to me, the best trades are the ones where everyone tells you you're an idiot for doing it. So, Patrick gives me lots of feedback on that case, which helps. And so I like to use sentiment a little more than Patrick does. Patrick will use sentiment as a shift and use it to go along with stuff, but he won't, as like demonstrated by the copper trade, he won't just buy it because everyone hates it, whereas I might. Would you agree, Patrick?
I just want to see that something is reached. Well, look, if copper got down to 375, testing a major support line where it previously traded, there's an asymmetry to attempting to buy a key support line, because you can keep your risk down to a small amount, have a lot of upside potential if it becomes a turn point. And so to me, those are there are periods where you can take that risk, but you have to pick your spots anyway.
Yeah, fair enough. All right, Daniel, unmute yourself and get back into it here. What do you got for the next question?
So this one's from Nebo. Hopefully I pronounced that correctly. Canadian/US housing market predictions for next year, particularly with Chinese economy cratering and the influence of it over China. I'm not sure that's catering or cratering.
It'll be cratering.
Yeah.
I'll start with this because I love this question. I am a huge Canada bear, and I'm not a Canada bear like one of these people that just hates their own country and is always shitting all over it. I am a huge Canada bear because everything that people are worried about in the US, Canada has done much worse. So let's just go through it here and think about what the people are worried about. People are worried about the debt. Well, the reality is that Canada, as the household debt, has way more than the US. We've gone, and I think going into 2005, before the great financial crisis, we were roughly the same. America was a little ahead of us, but then America ramped up their debt, and they were like 100% debt to GDP in terms of consumer debt, or might have even gone higher. And then the crash came, and they paid it back off, and now they're still like 75. In the meantime, what Canada did was we just kept borrowing and borrowing and borrowing. We're actually at a consumer debt to GDP level that is higher than America right now. The other thing about it is that we as a country did not spend as much fiscally as America did. So we don't have as much stimulus. And yet we raised rates just as much because our central banker, who's an idiot, basically thought.
Tell us what you really think.
Yeah, he thought that we had to be, cool like the Americans and don't be an Arthur Burns, and he cranked rates. And we aren't as able to handle this. And it's also because America, they have to raise rates a lot more because they're doing more fiscal stimulus, but they're also less interest rate sensitive because they have the 30-year mortgage. So a lot of homeowners weren't, feeling the pain of higher rates. So Canada's feeling the pain from higher rates. All of this adds up. Now you might say to yourself, but wait, why hasn't the Canadian economy, why hasn't the Canadian real estate market rolled over yet? And the reality is it's because we went in and let in an absurd amount of people into our country. And I'm all for immigration, but we just had the largest increase in our population since the baby boom. And actually, I think it was even bigger than the baby boom. And that's masking the pain that we're feeling. So if you look at our economy, the Canadian economy on a real GDP level, we seem to be doing all right. You look at it and go, hey, we're actually at the top of the pack. But when you go and compare it to on a GDP per population level, we're actually at the low end of the pack. And so what we've done is we've masked our problems with immigration, which has made our GDP seem bigger than it is. And we have rates that are too high. We have interest rates that are too high. We have debt levels that are too high. We have our housing that is much too high. If you want to be bearish on housing, forget about the US. Be bearish on Canadian housing. It is such a better trade.
Isn't it funny how Canadian banks like CIBC and Royal Bank are ripping these major bull runs like they don't give a shit?
Yeah. So listen, that's a different trade, and I'm not suggesting you go and do that. I have been advocating this for a while. I've been saying that Canada is going to have to lower rates more than the US, and that's been something that has continued to be the case. So if you're bearish on like the economy, on the consumer rolling over in the US, forget about US. Come to Canada because our consumer is in a lot more trouble. So in terms of my view, I think that real estate is a huge sale in Canada. It's going to get into real trouble. The only kind of outlet that's going to happen is that eventually, when things get bad enough, the outlet valve will be the Canadian dollar, and the Canadian dollar will sell off. And I'm a huge Canadian dollar bear. And everyone's been saying, but wait, the Canadian dollar is not going down. And the problem is they're all comparing it to America, and the US dollar just had this huge sell-off. So you have to look at it on the cross rates. But so that's my view on Canadian real estate. In terms of the US real estate, I'm not as bearish. I do understand kind of the pluses and minuses. I think there's going to be a lot just a muddling through. And I feel that in some ways, you might even have a situation where if they go and encourage more house building, which is what everyone needs in terms of North America, we need more supply. The housing stocks might actually be a good buy. In terms of the actual housing, I'm not sure that's a great buy, but the housing stocks might work. Patrick?
I have nothing to contribute. I mean, that's pretty much my position. I'm just surprised because like, a lot of people want to express that bearishness through making a market call like shorting Canadian banks. And it's been a pain trade. Like, Royal Bank's ripping higher like it's a bull market. And so even though that's the position, it's amazing how the market just it doesn't make it an easy way to express the trade.
Yeah, no, it's not easy. And the reality is with them lowering rates and they're oligopolies, they still find lots of ways to make money. And yes, Royal Bank's going to new highs, but BMO just had to write off a whole bunch of loans and stuff. So I've always said, if you're going to express that trade, make sure you express it by being long US banks versus short the Canadians. Next question, Daniel.
Well, funnily enough, I thought this would tie into another question. So from Asan Khan, do you think the Canadian banks are in trouble at all? I find they're very well capitalized, but there seems to be worries related to housing. So I don't know if you've answered that question already.
Yeah, I do think that the Canadian banks are sales, even though everyone's rushing into them. I have a good pal that he manages money as one of Canada's biggest brokers. And he always tells me, I always ask him, I say, when you get portfolios from other brokers, what do clients own? And he says to me, he says they own 3 banks, TransCanada Pipe, Enbridge, and then Mag 7. Meaning that they're like the Canadian banks are such a staple to people's portfolios because they've done so well, and they're not cheap. Yes, they might continue to go up, but I feel that there's better things to own out there than these banks that are exposed to this potential real estate loss. And yes, Royal Bank might be able to skate their way through it and do well, but as a group, they're still exposed to housing. And if housing in Canada ends up being as bad as I think it's going to be, then nobody's going to win out of it.
Right.
Do you have anything, Patrick? What do you think, Canadian banks? Patrick's scared of the Canadian banks.
No, like, you know what? I bought some put options in the Canadian banks and ate it Like I'm bitter.
All right, next question, Daniel.
Okay, so then we'll move on to there's a few questions here about China.
Okay.
And then we've also got some questions about the VIX. So what would you prefer to answer first, China or the VIX?
China. Let's do China. You know what? Share my screen. I'll want to show this chart.
Okay, cool.
What's it called? So this is the China A50. And just first of all, let's go on a weekly chart and just highlight the fact that this has been a devastating bear market, where this thing started declining off the peak at the start of 2021. And it's been a perpetual bear decline, persistently lower highs the whole time along. And a lot of people were holding hope that that low was in, and the market was going to establish, a new bull trend. But really, the last 4 months has been a complete fade, and the pattern of distribution of lower highs, lower lows just continues below its 50-day moving average, trending down. I mean, I think China is going for a full double bottom retest of its lows, and the bottoming formation will probably take the rest of the year.
Whew, that's a bear.
Well, I mean, look, no, come on. It's not an easy money trade, because the bear market already happened over the last 3 years. It going down to retest its lows is just a bottoming formation.
Daniel, is there any specific questions, or did they just want to ask about China in general?
It was just your thoughts on China.
Okay.
Pretty much.
I'm going to jump in there. I think that China is making the same mistake that Europe made, that Japan made, and our buddy Louis Vincent Gave highlighted how maybe it's not a mistake and they're doing it on purpose. And the reality is that they're trying to fix everything with monetary policy and not using fiscal policy. And in essence, they've entered into what's known as a balance sheet recession. And when you get a balance sheet recession, lowering rates doesn't really help, because the reality is that people don't want to borrow. And that's when you look at the Chinese bond market, it looks a lot like the JGBs did in the 1990s or the Bund did in the 2000s. And what I worry about is that we're going to continue in this kind of balance sheet recession, and rates are just going to go lower and lower in China, and that nothing's really going to get fixed, and the economy is going to struggle through. And although Louis has the opinion that this isn't as bad as it seems, I might not disagree with him that from a societal point of view, it might be the best thing to do. I'm not sure, though, that if they continue on this path, that it'll be the best thing to do from a financial stock point of view. And interestingly enough, Patrick, a couple of years ago, if I said to you, or maybe not even a couple of years ago, 5 or 10 years ago, if I said, what do you think is going to be the best performing bond market, China or the US? Almost nobody would have picked China. And yet the Chinese bond market has been absolutely stunning. Right. And the amount of money that people have made from that is just unbelievable. And it's just, unfortunately, it just reminds me very much of the situation that we had in Japan for the 90s and the 2000s and 2010s. And it reminds me of China. Of Europe. Europe, when they went and had negative interest rates. You can't fix things. You can't fix a balance sheet recession with, lower interest rates. And that's what worries me about China.
Mm-hmm. Sure.
Next question, Daniel.
Yes, sir. So let's answer. Let's see. So we got a couple from CH.
Okay.
So there's 2 ones here. He or she is asking when the VIX when the VIX spikes up, the Vikings, yes.
Yeah.
What do you use to gauge if it will continue to run up or go back down? And then to add on to that, short-term outlook for gold and silver. I'm assuming they're looking for some opportunities. So the VIX
is difficult because it's prone to these spikes that you get. And I use sentiment a lot for the VIX. I kind of try to figure out what the positioning is. And although, Patrick, did you get rid of that 65? Oh, yeah. first of all, just a quick note on the VIX. Everyone's talking about the 65 print. The 65 print wasn't real. It never really traded there. It was a bad quote. Market makers walked away that morning. And so what was it, Monday morning? Yeah, it was Monday morning during this August swoon. We had this situation where the market makers walked away, and that created an environment where the VIX appeared to be much higher than it was. So if we were to look at like the VIX front month future, it traded gobs at 35. That's probably the spike that was like the real, because you could actually sell that. Like that was a tradable price. Now, what do you use to try to determine, is that going to continue? There's no real easy way. I'll be honest. I was advocating long VIX for a long time, and I missed the top, because the reality is that once it gets kind of 25, 30, it's, you know, that eventually it's going to spike right back down. So I just peel it all out. And I guess you could think about, we had Jem Carson on, and if you're interested in really getting into the VIX, you should go back and listen to that interview that he gave, because he explained a great way to determine if the VIX is going to get worse in the coming hours, trading sessions. And what he described is, you needed to watch what he calls nickels and dimes, I think he called them. And what those are out of the money put options that are like a week away, that the market makers are buying, not because they want to buy them, but because they need to buy them. And ultimately that is what causes the real spikes in the VIX. You know, when a market maker is short volatility and just has to protect himself or herself, and that's what those things go bid. And so he described watching those things, and he said, if you ever see them all of a sudden go from like a nickel or a dime to like half a dollar to a dollar, that's when you have a problem, and that's when things are going to get a lot worse. And there were cases in this last situation where it did give you a clue. So if you're interested in the VIX, make sure you go listen to that Jem Carson interview we gave. I think it was one of the, like Jem gives a lot of interviews, but I specifically asked him questions that were trying to be like green in nature, and that they'll always be relevant. Ask him like his process, and he was very clear and very open about that. So I thought it was a particularly great interview in terms of with him. Patrick, why don't you give us your voodoo magic Crayola stuff on the
I was going to say that the one rule I have is not to use technical analysis on the VIX. So I won't do it.
Oh, good. Yeah.
I mean, you know what? Support resistance levels, just knowing like where vol is getting to a level where we haven't seen before. You want to make technical observations, but I wouldn't use technical analysis to make trading decisions based on signals, or especially off of things like oscillators or moving averages. No, don't do it.
Don't do it.
Don't do it.
Listen to Michael Jordan. Okay. Give us your voodoo magic though on silver. We've talked a little bit about, like, pull up the charts and show us where the crayon lines are for silver and gold.
Silver and gold. Okay. Well, first of all, gold has been in the clearest bull trend. It's above its 50-day moving average. It's moving well at any one time. Like, what were all these previous highs over here? At any one time, a quick Fibonacci retrace could easily make it back to 2450 on the downside, for where it could be just a tactical buy on dip. But what's clear is that there has not been any real participation to the upside on silver the same way. It's actually sequentially failed to make higher highs both in June and in August, and it's definitely showing a little more distribution than gold. It hasn't done anything horrible, but it is by far a weaker market. And I think that you have to be patient on silver, because I think you're going to need a genuine new momentum push in gold ripping to like 2,800 for silver to get there and its engine started up again. This could easily go for a double bottom retest of 27 and just meat grind in this ranges down here. I think gold is a more pronounced bull market here, and you have to respect that silver just hasn't joined the party yet.
I'm going to say one quick thing. I think it was Rick Rule, but I'm not exactly sure. He said, Central bankers buy gold. They don't buy gold stocks, meaning that this recent rally in gold, it's been driven by central bankers looking to diversify their foreign exchange reserves. And I really think that is true. And I'll just add kind of the Kevin Muir corollary to this. It's that central bankers buy gold. They don't buy silver. And so if this bull market in gold is being driven by central bankers, as I do believe it is, then it makes sense that silver is not performing as well as gold. And that the point where silver will outperform is, I suspect, when the West comes back and starts to actually truly be bullish gold, meaning that the Western investor starts buying it. And at that point, I could see silver starting to go.
Right.
All right.
Sorry. I was just going to highlight the fact that I think silver, more than anything, needs retail participation. And that means that there has to be a new kind of gusto about the bullishness of everything in the precious metals space, and everyone will chase silver and squeeze it in that environment.
Which I think is, we're saying the same thing, so it's going to be wrong. Daniel, what's our next question, buddy?
Well, actually, I think we should just take a very quick question that's not related to the markets, because I think it's actually a very, very important question.
Okay.
Which this one's from Todd, and it says, question, what wine is Patrick drinking?
Patrick, tell us the wine you're drinking, buddy. Come on, Patrick.
No.
Come on, you got to No, Patrick, you gotta be a good sport. You got to be a good sport.
I forgot the brand.
Okay. Well, it's okay.
Well, listen, I'm gonna spill the beans. If Daniel's scared because that ultimately Patrick pays Daniel's salary, so he doesn't want to say too much. But I will say it. Patrick is busy taking care of himself, like a 21-year-old guy that's just graduated from university, and he's trying to get himself in the tip-top most shape of his life. 53 going on 23. And so his what is it, your nutritionist? Is that correct? Is that what she is? Your nutritionist. Is this the one that you Skype with from California?
No.
Okay, that's another one. That's another nutritionist. Okay. But anyways, she told Patrick, of course it's a she, that he's not allowed to have any more alcohol, or you should cut back on the alcohol.
No.
So you're drinking grape juice, basically. You're basically drinking grape juice. It's
that's what
0%.
wine is anyway.
I know, but it's 0%. And I'm not going to shame you. You should just own it.
You did.
Yeah. So it's some god-awful 0% wine that Patrick is drinking, trying to take care of himself, trying to be a steward of his meat pocket, the meat thing that he's running. Okay, next question.
Oh dear. So this one is from RWAL91. SSI is closer to contrarian sell signal following last month's increase. The SSI is the closest it's been to.
What is the SSI, Patrick?
That's a good question.
Is that? Let me look. I don't. Is SSI?
This might not even be a question. This might. I'm not sure if this is a question. The RWAL91. Can you write it again so that
we can understand it? Okay. Next question.
Next question from Spoos Trader.
Nice.
Nice. Why do you think the US will come? Sorry. Why do you think the US will come off? Will come off. Where do you think? I think it's meant. Where do you think? When the US has all the comparative advantages like plenty of cheap energy, lots of agricultural land, good demographics, etc.
I think great question, and I will never say that the US won't win in the long run when you look at the economic outputs. But the question that everyone should be asking is, what is priced in? And ultimately, this is kind of the same thing I'm feeling right now with the Mag 7. I went on a little bit of a rant on the weekend on my audio thing that I create every week. And it's like I see more and more quote unquote investors just talking about how you have to own AI because it's the next big thing. And they're not stopping to think about how big these stocks are and whether this is a good bet. And it's like, I always say, if you go and you bet on, you say the Steelers are going to win the Super Bowl, and let's say the Steelers are heavily favored. Okay. Are you really, and if you go bet on that, you might seem like that's a great idea and you're really smart for coming up with the answer. But the reality is, over time, because the Steelers might be overpriced and you're not getting enough actual return on your investment, it's a losing trade. And this is what I feel about Mag 7. This is what I feel about the US. It's just like everyone, if I have to hear one more time, it's the cleanest dirty shirt in the laundry, I'm like going to shoot myself. Like I can't stand that thing, because it implies that no matter what, there's not a price where you'd go the other way.
It's a human nature. It's a human nature for us to always say some sort of statement. It's like when ag stocks were going up, the saying was, well, everyone's got to eat. Well, you make some statement that's irrefutably can't be disputed, and therefore that means there's no risk in the stock, and that you don't have to manage it, and you don't have to do anything because everyone's going to eat, so you're going to be fine. Like the thing is, these points that are being observed are all true, but that doesn't change the markets from being the markets, and the markets do what the markets always do in every cycle. And you can't just look at these kind of points and say that makes it riskless or something.
Right. It's trading is about getting the call right. It's also the way you get paid when you're right and you're wrong. And Patrick, on this note, I saw the other day that this guy was on CNBC, and he's telling us how if we get a situation where the economy grows, then the Mag 7 is going to go up. And if we get a situation where the economy goes down, then interest rates are going to go down. And guess what?
Mag 7s are going to go up.
Yeah. So it's like, okay, and there never was an idea, even a contemplation, oh, is this fully priced in? Is everyone already in on this price? And that is, to me, what is being missed. And it ends up being a little bit of a self-fulfilling prophecy, right? That stock US is doing well, everyone rushes into it, convinces everyone that you have to own nothing but the US. And that's why ultimately you get these big, huge cycles. And I just think the America market is a great market, and there's no doubt it's had the most growth. But at the same time, I believe it's fully priced, and the potential for mistake is large.
Yeah.
All right, Daniel, next question.
Okay, let's have a look. Well, this one's about me, actually. And it says,
okay, good.
Yeah, so from Zelen Lee. What a lovely person this is. If you put Daniel's picture as the thumbnail for each episode, your viewership and gender diversity score will rocket.
That's
Thank you. Thank you for that.
I said that when I saw him. I never met him. I go, what the fuck are we putting our faces on this? We should put Daniel's there.
Well, thank you very much. That's very kind. So we have one from Lauren, Loran. Do you think you've answered this question, though? Because I'll answer it, but it's what are the most bullish bearish scenarios for gold? So if you feel like you've answered that,
yeah, let's keep talking something else other than gold.
Okay, sure. So we've got from, I'm not sure, Buryoy. I'm not going to do my best French accent.
Okay.
The jobs data is so insignificant for the markets beyond the day they are published. I guess that's not a question, that's just a comment. But he does ask, the most important question remains, a certain other podcast, will that person remain bullish gold till it hits the unofficial reverse? Don't know if you want to answer that or make a comment.
I don't even know the unofficial reverse. What's the unofficial reverse, Patrick?
Okay, moving on.
I'm being goaded into it. No, I'm not doing it. I'm not doing it.
I don't know. I'm shutting up.
I'm going to shut up.
Okay.
Okay, cool. So from Spoosh Trader again, I know we've answered one question, but we'll answer it again. How do you think about inflation versus commodity prices? Many people say that we're headed for 40 USD oil. However, if the inflation is adjusted past 15 years, you get more like $55. Do you want to talk oil, maybe energy?
Why don't we talk about oil? We haven't talked about it yet.
Yeah, let's do it. It's ugly chart, by the way.
Yeah, so I actually highlighted in my letter that Oxy. I take it that that Stanky guy, he was actually very good, and I'm going to try to get him on the show. I'd love to have him on. He was highlighting how Warren Buffett has stopped buying Oxy, and he thinks that it's been driven to a level that Warren Buffett, when he buys a lot, and so it's actually expensive versus its peers. But I was pulling up the chart of it, and it's like, Patrick, it's a quadruple bottom or quintuple bottom, and it's looking scary. And I feel like XLE is very similar, right? Like pull up XLE, which is the ETF. Not quite as bad as Oxy. But like going back to Oxy, it feels to me like it has to test that bottom and then it's going to break. And I don't know if you're going to be bullish on it. Don't be bullish till it breaks, because I feel like it's going to break.
Yeah.
Don't you think?
Well, look, these stocks are being distributed. There's no way to put it. You can't make this a bullish chart. Like, the thing makes lower highs, lower lows, is continuously. I mean, look at Oxy is trading below those December and January lows already. Like, the downside window is very much open, and there's no sign of a bottom on the short term. What is the thing that could put in a short-term low is whether oil itself puts in a bottom. Now you can see the kind of 2-year low for crude oil was down in the mid 60s. And a couple of these different technical measured moves are all down to like the 68-70 zone, where the low came in here in December. It's entirely possible that oil just ventures down into the bottom end of this range. And that's where we establish a bottom. And if that's the case, if oil bottoms in these areas, and for whatever reason in the fourth quarter starts to turn, that could be the window where energy stocks respond. At the moment, though, these are all very bearish charts, and on the very short term, they're likely to go lower. And so it's one of these scenarios where you have to see how it plays out, see how bad things get, and then look for where the bottoming formations come in and where the buying opportunities will emerge.
Yeah, I tend to agree. And I think that the reality is that it still seems like we have a lot of bulls out there. I'd like to see people actually getting bearish.
Yeah.
And that would be, to me, the signal that you should be thinking about the long side. When you get people coming out and telling you, oh, you got to short these things, they're headed a lot lower, and that's the sign that you should be buying them again. And until then, I don't know. It feels like they want to go lower, and it feels like they're gonna scare folks. They're gonna scare the longs. That's how I feel.
Right.
Daniel,
was that the answer? Done?
Yep. Well, I guess about inflation, it's a little more complicated than that, in terms of like you can adjust inflation, adjust all commodities. You can inflation adjust, the actual S&P. You should always be talking about things in real terms. There's no doubt about it that a lot of folks don't think about inflation correctly. Like, if you have a situation where, let's just say, let's take the 2-year now. Some people bought the 2-year when it was 4%. And then what happened was we had, let's say a year and a half or 2 years of inflation that was 4 to 8%. In real terms, you're losing. And not only that, you could have actually made more by hanging on, and rates went higher. So although you might be winning in nominal terms, and if you own the 2-year, you just outright without any leverage, you would have actually made money. But when you talk about it in real terms or opportunity terms, you actually lost. And I think that is a thing that a lot of people haven't kind of come to grips, because we haven't had inflation up here in a long time. Like, let's just take the stock market. That's another perfect example, and like how it relates to inflation or interest rates. The reality is that if the stock market goes up 10%, people think I'm up 10%, but overnight on Fed funds earned you 5 3/8. So really, what did you made 4 5/8 is what you made versus your riskless thing. And that's the problem, is that we've had a situation where interest rates were so low, inflation was so low, we've forgotten about talking about things in real terms or, adjusted for interest rates. And it's something I see that the industry itself is having trouble dealing with. I saw an open letter, Patrick, signed by all these end users, basically to hedge fund managers, telling them that they should have hurdles on their funds because they're getting paid 2 and 20, but they're not getting paid 2 and 20 over a certain hurdle. They're getting just paid outright 2 and 20 or whatever the number is. And in the days when interest rates were zero, it didn't matter because the hurdle was zero. But now all of a sudden, these managers can just own like T-bills,
huge amounts of T-bills, and still get money
and get paid, 2% on their assets because they're making enough that way. So it is something that we have to deal with.
Yep.
All right, and that's 2:00, right, Daniel?
I say we got 4 minutes. So maybe
because we're gonna go because we started late. Okay, fair enough. Give us another couple questions.
We got a couple of. Sorry, I've got a lot of dogs in the background.
I know. Why don't you tell us how many dogs do you have there?
There's 7. Yeah. No, not all mine though, so don't worry. Right. Okay. So let's go for. So Todd was talking about AI. So maybe just very quickly we'll touch on that. He's asking what's your issue with AI? Issue, and how do you explain NVIDIA, etc. So do you want to maybe touch on that?
Sure. Well, let me start so that you can correct me there, Kevin. No, but okay. But in the end, at least there's a typical CapEx spending cycle that's always played out, and at some point, these blowout numbers that these companies are showing will start to slow, and they will reverse some of their sales targets and so on. And you're going to see that the lofty valuations that many of these are given are just going to have to be the air's got to be taken out of the excess valuations, and the stocks mean revert. There was that one Goldman report that showed numerous times how NVIDIA has lost 50% of its value during the turns when a CapEx spending cycle ends. It's just what the market has always done in the past. I'm not saying it has to happen this time, but it's like expecting that somehow these things just stay up and always stay up here, and they don't correct or mean revert is just, there's not a lot of historical market precedent that's how markets behave.
And my issue with AI is that this is not that much different from all the other little mini rolling bubbles that we've had. It was 2 years ago, people were convinced that electric vehicles were going to rule the world, and we were going to be all out of electric vehicles, and everyone had to own EV stocks, and you had these ridiculous valuations on these things, and most of those have come crashing to earth. And I just think that AI is a story that is bullish, and I'm sure it's positive for computing. I'm sure it's positive for our society, but it's just another tool. And people think that it's this revolutionary thing that's going to change the world. I'll take the other side of that. I actually think that in the grand scheme of things, the internet that connected everyone was probably a bigger deal than AI. And I suspect what's occurring right now is that we have these kind of 6 or 7 big clients of NVIDIA that are all trying to race and buy all the product and pushing up the prices of these chips. And I'm really worried that the demand, the actual demand for NVIDIA for AI products is going to be a lot less than people expect. And you're paying a huge multiple, 40 times sales, for one of the world's largest companies. And I highlighted the other day that there was this Scott McNealy, founder of Sun Microsystems, back in 2002, had this big speech he gave and he said, "What were you thinking bringing my stock to the price of 10 times sales?" Well, we're now at 40 times sales. This is absolutely ridiculous, and I just think it's going to end in tears. It's
just gonna be a normal market cycle, as it'll do what it's always done in the past.
Yeah, so it's gonna go down at least 50%. It could be 2/3 or whatever, and people will be like, oh geez, and then they'll be on the next thing, and people will asking me, why don't you believe in this? And I do believe in these things. I just don't believe in paying the ridiculous prices that you're paying for it. And that's ultimately, again, the issue with all this stuff. There is nothing wrong with AI. It is a great technology. There's nothing wrong with NVIDIA. It's a terrific company. The question is, what are you paying for it? And is that appropriate? Yeah. Next question, Daniel.
Do you want to have a next question, or we got?
Sure, one more. Let's finish with one last one.
You want to finish with one more? So I think a good thing to finish off would be, there was a question about what you think is good right now, like in terms of what stocks are good now. So maybe just finish on a quick fire of like what you think is good, what you don't think is good.
Long bonds.
Well, actually, that probably is Patrick's pick. Are you going to pick something? Leave him with something that you like, Patrick. Is it bonds?
I think bonds belong in a portfolio, but I still like pharma here.
That's your pick
on that one.
Okay.
Yeah.
I'm going to give a pick. It's going to be Japanese stocks. And the thing that people are missing about Japanese stocks, Patrick, the thing that people are missing about Japanese stocks is that they think that raising the rates are going to be negative for the economy. They think it's going to be negative for the stock market. And the surprise will be that just like when the US raised rates, it created a larger deficit, which created actually more economic activity and actually sent our prices of our stocks higher. The same thing will happen in Japan, but it might even be supercharged because they have even all the more debt. So I think the thing that everyone's missing in terms of Japan is they think that a Bank of Japan raising rates is negative. I actually think it's positive.
Okay.
All right. So thanks for tuning in, everyone. We stumbled through this. Lots of fun.
I had a great time. I know
you did with your 0% wine.
Why don't you just remind it? Let's end on a high note.
Thanks, everyone.
Thank you, guys.
All right. Cheers.